Whenever I discuss Bitcoin with my no-coiner banker friends, they always tend to bring up tired stereotypes about its shortcomings. There are many of these, but perhaps the most common is the markets are so heavily manipulated by whales. And in response to that, I always say, bankers who work in glass skyscrapers shouldn't throw stones. This is because market manipulation is a practice that is actually more common and pervasive in some traditional markets. In fact, it's been around for centuries in one of the oldest markets on Earth, the commodities markets. My name is Guy, and today I'm going to tell you about the vast scale of market manipulation in this worldwide market. By the end of this video, you'll see why I think that market manipulation in crypto is just a drop in the ocean compared to manipulation happening elsewhere. I'm going to warn you now, these master puppeteers include the likes of JP Morgan and the Rothschilds. So, be sure to watch until the end to get the full lowdown. Before I jump on into this, my legal guy has told me to say a few things. I am not a financial advisor. Sorry to let you down there. This means that everything in this video is for entertainment and educational purposes only. With that mumbo-jumbo out of the way, I want to welcome anyone discovering my channel for the first time. Howdy and welcome to the Bureau. It's your hot one-stop crypto shop letting you know exactly what's what. News, reviews, analysis, and much more. I also want to remind you that this video and all the knowledge contained within is completely free of charge. Wait, I've changed my mind. All the pearls of wisdom I'm about to share can be got for the price of a smash of that subscribe button and a flick of that little bell. Do that, and the powers that be at YouTube will make sure you don't miss any of my videos. Oh yes, some of you might have noticed that I'm looking pretty fly for a crypto guy today with this cracking t-shirt. I actually drew up the blueprints for this one myself and have recently opened my own Coin Bureau swag store. If you make it to the end of this video, I'll tell you how to get one. And finally, I just want to point out the timestamps below. If you're rushed for time, use them to jump ahead to the sections of this video that interest you the most. Okay, good to go? Let's expose this manipulation. Let's face it, market manipulation does happen in crypto. I mean, do you really think that price charts like the one right here are natural? Then you have all that crazy wash trading jacking up the volume reported by no-name exchanges. I mean, do you really think that HBTC, DSDAC, BitZ, ZG.com and HiDAX exchange all have in excess of $6 billion trade volume from real users in a single day? Personally, I don't know a single person with an account at any of these exchanges. Or have these exchanges got people trading back and forth amongst themselves to increase that trade volume and create the illusion that a ton of people are using these exchanges? I'll let you be the judge of that. Next is another form of manipulation called spoofing. I'm sure most of you traders out there might have spotted this when dabbling on an exchange. Put simply, spoofing is when someone puts a fake order in to buy or sell a crypto. They then withdraw the order before it's executed. These orders can have consequences when it comes to other orders that can then move the price of the asset. So, if you've ever noticed a massive buy or sell wall on an exchange, only to see it disappear in the blink of an eye, then chances are you just saw some spooky spoofing. I do hope that those fake orders didn't influence you to make the wrong trading decision. Trading algorithms and high-frequency trading bots are certainly not illegal. These tools can be programmed with chosen rule criteria to sell or buy a crypto asset at a certain price point. They take all the human emotion out of trading and can execute orders in a fraction of a second. The truth is that most trades that happen in the crypto markets are not done by people like you or me clicking buttons in our bedrooms. Instead, it's these trading bots and algorithms that dominate and can lead to the manipulation of prices. Finally, you have shady marketing tactics which can have an immense impact on the price of a cryptocurrency or ensuring that a crypto project is fully funded. I'm sure many of you have heard of the likes of Floyd Mayweather and DJ Khaled being paid tens of thousands of dollars to promote random cryptocurrencies without disclosing that sponsorship during the ICO hype of 2017. That dishonest celebrity endorsement led to some of their followers losing a bunch of money on the Centratech ICO. Naturally, the US Securities and Exchange Commission had a thing to say about all that when it came to dishing out fines to those aforementioned celebrities. Then you had arguably the world's best football player, Lionel Messi, promoting Sirin Labs as their brand ambassador. Goodness knows how much that endorsement cost. However, with that sort of backing, it's probably no coincidence that Sirin Labs' SRN token rocketed to an astonishing $345 million valuation. The truth of the matter is, if you have a celebrity telling their fans how great a crypto project is, then it's not surprising when a bunch of their fans go out and buy it. After all, these celebrities are not being paid boats of cash for nothing. Naturally, that type of buying pressure can certainly inflate the value of a cryptocurrency way beyond what it's reasonably worth, aka a form of manipulation. Now, I've personally disclosed every sponsor I've ever had on this channel. However, if I were Guy the Crypto Crook, I might tell you about how amazing a cryptocurrency was without disclosing that I was saying that due to a sponsorship arrangement. If some shady crypto content creator were to do that, then it would be a form of price manipulation. Also very illegal, I might add. These are just some of the tactics. I've actually done an entire video on crypto market manipulation, which you can watch right here. So yes, from what I can see, manipulation is certainly there in crypto markets in one shape or form. But this absolutely pales into comparison when we look at the dodgy practices going on in the commodities markets. So, let's dive on into those murky waters. Here's a question. Are you married? If so, the chances are that you bought or you wear a pretty snazzy diamond ring. Diamonds are actually one of the oldest commodities out there and have been used as valuable trade items for over 2,000 years. Those ancient diamonds were damn rare until 1869. So, what happened then? Well, a shepherd boy stumbled across a whopping 47-carat diamond by the banks of the Orange River in South Africa. That diamond is now known as the Star of South Africa. And it appears that my British forefathers smelled an opportunity, and all that kick-started the scramble for Africa and a couple of wars into the bargain. In 1871, the De Beers brothers secured themselves the biggest diamond mine in the world, known as the Kimberley Mine. Sure, there were a bunch of other diamond mines found in South Africa. However, here was the problem. The British owners of the mines knew that the value of their diamonds depended on their scarcity and demand. All that was a bit of a problem due to the sheer numbers of diamonds being mined in South Africa, coupled with lackluster demand. Seriously folks, in the 1880s, diamonds commanded about the same value as a semi-precious stone. The more they mined, the more the price dropped. That's when Englishman Cecil John Rhodes stepped in and began buying up all those diamond mines that were closing down due to the saturated diamond supply. That included the now legendary De Beers mine. So, how did Cecil Rhodes acquire all those South African diamond mines? Well, he did so with a little help and financing from Rothschild's bank. In 1888, the remaining mine owners decided that the only way for the diamond industry to survive was to consolidate and essentially create a monopoly. That took the form of a company called De Beers Consolidated Mines Limited. From then on, that company was in control of pretty much every South African mine. Then good old Cecil started setting up mining shell companies to create the illusion of competition and that the market set the diamond price. The truth is that this didn't matter, as De Beers controlled literally all the diamond supply, which turns out to be pretty handy if you want to manipulate that diamond price. By the time Rhodes died in 1902, De Beers controlled 90% of the world's diamond production. Quite the monopoly if you ask me. The Premier Mine was one of the only diamond mines in South Africa not owned by De Beers. The owners didn't want to strengthen that De Beers monopoly and instead sold to the Oppenheimer brothers. It was then in 1905 that the largest rough diamond ever found was unearthed in the Premier Mine. Ernest Oppenheimer then went on to found the Anglo-American Corporation Mining Company in 1917 with the backing of our friends from JP Morgan. Mr. Oppenheimer then used the Anglo-American Corporation to simply buy up shares in De Beers and finally became the majority shareholder in 1926. Quite the devilish plan to secure that diamond monopoly. Sure, stockpiling diamonds and selling them strategically was one way to influence the price of the commodity. However, let's face it, any master manipulator wants to have full control of the price. To do that, De Beers needed to stimulate global diamond demand. But how to do that? Oh wait, marketing. With World War II on the horizon, De Beers was scouring the globe to find a country with the highest potential to support a growing diamond market. So, what country did they choose to focus their efforts on? Well, that would be the good old USA. Part of the reason for this was the fact that since the end of World War I, the amount of diamonds sold, measured in carats, had fallen by 50%, and the quality of diamonds was at rock bottom. So there was massive potential for growth. Fair warning, De Beers' ruthless marketing strategy to manipulate the price of diamonds higher is going to make those influencer marketing strategies look like something a 5-year-old would come up with. First up, those De Beers chaps got themselves an elite marketing agency called NWA. That agency then did a bunch of market research on the attitudes of Americans to diamonds. It turns out that back then, in the late 1930s, Americans associated diamonds with luxury and as being for the super rich. Not much has changed today, it seems. Here's the problem with that attitude for those diamond stockpilers. Most people are not super rich, and the super rich are a tiny market. So the trick to stimulate demand would be to effectively market diamonds to a wider range of people with differing income levels. So, how do you get people to buy a shiny gemstone they don't need in a bad economy? Simple. You tie that product to something emotional. And what is more emotional than love and marriage? At the time World War II was popping off, just 10% of engagement rings contained a diamond. That meant there was massive growth potential for that market and the opportunity to strengthen the tradition for engagement rings containing diamonds. Those savages at NWA then proceeded to unleash one of the most successful marketing campaigns the world has ever seen. That included using celebrities and the mainstream media to showcase celebrity proposals with diamond rings and talk about it on radio shows. In essence, this was kind of a native ad, a bit like Aston Martins in James Bond films. That marketing effort didn't include brand names or anything like that. De Beers owned most of the world's diamonds anyways. Instead, what was promoted was the idea of diamonds symbolizing love and how bigger diamonds equaled more love. That initial marketing blitz was pretty damn successful, with US diamond sales rising by 55% in just 4 years. In 1948, De Beers started using what's probably the most effective marketing slogan ever. And that would be, "A diamond is forever." Yep, that slogan is probably vaguely familiar even to those bachelors and bachelorettes due to the James Bond film Diamonds Are Forever. A pretty sweet advert for that idea De Beers was wanting to push. So, why was this slogan so genius and so underhanded when it came to manipulating the price of diamonds? Well, it's a bit like a shitcoin project in a way. If you want to manipulate that shitcoin price, one really effective way of doing it is creating a hodl mentality and having a really low tradable supply. That means you don't need much buying pressure to moon up the price. Now think of that slogan, "A diamond is forever." What does it do if you buy into that idea? Well, I'll tell you, it creates a hodl mentality, where diamonds simply don't hit the secondary market often. Imagine if all those people buying engagement rings actually tried to sell their diamonds, only to find out the low intrinsic price of the gemstones themselves. I imagine that would upset quite a few people. So yeah, what that slogan did was mean that De Beers could sell diamonds for a highly manipulated price, with the consumers being none the wiser when it came to the real intrinsic value of the commodity. But what about pricing diamonds? Well, NWA covered that too. In the 1930s, marketing campaigns promoted the idea that 1 month's salary was the price you should pay for an engagement ring. In the 1980s, that was jacked up to 2 months' salary. Marketing campaigns ran throughout the US with the slogan, quote, "2 months' salary showed the future Mrs. Smith what the future will be like." Even today, the chances are if you're thinking of proposing to that special someone, you'll have the idea that the right price to spend on that engagement ring is roughly 2 months' salary. I hate to break the news, that's all down to those De Beers marketing campaigns. So, now you know the real reason diamonds have held such valuations for decades and the sheer scale of price manipulation for this commodity. It's honestly the type and scale of price manipulation that I'd expect from a James Bond villain. Ask yourself, what's more manipulative, the shady marketing tactics to manipulate crypto prices or those executed by De Beers to control the diamond price? Personally, I find De Beers way more scary. That's mostly because everyone is none the wiser. We've all been living a lie that was started and perpetuated by those dastardly dons at De Beers. And speaking of pervasive market manipulation, that brings me on to the multi-trillion-dollar gold and silver markets. So, let's take a plunge into those, shall we? Let's start off with silver. Back in January 1980, the Hunt brothers famously created one of the biggest financial bubbles in history, manipulating the price of silver from $6 an ounce at the start of 1979 to a staggering $50 an ounce by January 1980. Now, I know that us hardcore crypto guys might look at that and think that, well, less than a 10x is hardly a pump. However, what we have to understand is that the size of the silver market is vast. How vast? Well, according to the likes of Bloomberg, silver is a $5 trillion market when you factor in spot and paper silver markets. So, that's considerably harder to move than some random altcoin. It all started in 1974 when the brothers accumulated futures contracts worth 55 million ounces of silver. To put that into context, that was about 9% of the global supply of silver at the time. So, what did the Hunts do when those contracts expired? Well, they actually took physical possession of the silver. That's not normal and a logistical nightmare, I can tell you. So, the brothers sat on their vast pile of silver for 5 years. Then they teamed up with a few Saudi business partners and bought an additional 43 million ounces of silver contracts, which expired a few months later. As that expiration date approached, the silver price doubled from $8 an ounce to $16 in the space of 2 months. As other traders found out about this massive position, they started buying up silver, a bit like how a crypto pump and dump coordinator might accumulate a ton of coins at a low price and then tell their followers about some hot shitcoin. The problem for those commodity exchanges was that they only held 120 million ounces of silver. That meant that if the silver contracts buyers wanted to take physical delivery of their silver, then the exchange would have to go into the spot market, buy up the silver there, and push up the price. The Hunts doubled down and bought another 32 million ounces of silver. By this time, one CFTC official estimated that the brothers controlled 77% of all privately owned silver. It was that supply shortage which rocketed the silver price to $50 an ounce. And the subsequent dump was due to the commodity exchanges forcing the Hunts to sell. This was due to regulatory changes saying that no investor could hold more than 3 million ounces of silver contracts. So, that's how one of the biggest pump and dumps in history happened in those murky commodities markets. A serious amount of price manipulation. In more modern times, you have the likes of good old JP Morgan getting caught with their hands in the cookie jar. Yep, the same JP Morgan that I alluded to earlier. The JP Morgan that had to pay billions in fines on mortgage fraud related to the 2008 financial crisis. The JP Morgan with a CEO that's called Bitcoin a fraud on multiple occasions. But where was I? Ah, yes, market manipulation. Well, these fine blokes were recently fined $920 million in relation to a racketeering case. Here, they were accused of manipulating the futures and precious metal markets. Fun fact, the traders in this case were actually charged under the RICO Act, a statute generally reserved for organized crime kingpins. So yeah, honest bankers. Anywho, the reason why this was important is that a lot of people were talking about manipulation in the precious metal markets for ages and were frankly written off as conspiracy theorists. So, how were those city boys manipulating those prices? Well, it turned out that they were spoofing those commodities markets to create the false impression of buy or sell interest to raise or suppress commodities prices. The real scary thing is that this all took place between 2009 and 2016, so 7 years of funny business. The important thing to note here is that if it wasn't just one trade, this literally covered thousands of trades over a long period of time. we really need to ask ourselves how it is possible that so many people were complaining to regulators, regulators looked into it, and nothing was found? The emails and chats that were made public showed the depth of this manipulation between traders and different banks. Traders coordinating to manipulate prices. What's worse is that JP Morgan's record fine for commodities manipulation isn't a one-off. In recent memory, Barclays was slapped with a $44 million fine for gold price fixing, and UBS paid a $15 million fine for the attempted manipulation and spoofing in precious metals markets. Deutsche Bank, HSBC, Morgan Stanley, and more were all either fined or investigated for commodities price manipulation in the last couple of years. Even worse, that's the manipulation that's known about. God knows what the true scale of it is. So, I know it's fashionable to cheer on the idea of bankers getting into crypto. However, if what's been going on in the multi-trillion-dollar commodities markets is anything to go by, crypto would be a lot safer without these master manipulators jumping in. Alright team, that's about all I have time for today. However, I do want to share some closing thoughts. I'm going to be the first to admit that market manipulation does appear to be happening in crypto markets. However, the point of this video was to show you the vast amount of manipulation that's been happening in commodities markets for over 100 years. What's even worse is that I've just scratched the surface here. When you look at these commodities markets through the lens of history, is it surprising there is manipulation in crypto markets? I think not. Indeed, I would argue that a certain level of manipulation in crypto is to be expected and will probably exist for our lifetimes and beyond. I wish we'd have crypto markets devoid of manipulation, but the pragmatist in me says otherwise. However, the portrayal and narrative that you shouldn't get into crypto because of market manipulation doesn't really carry much weight when you see how popular commodities like gold, silver, and diamonds have been manipulated. Indeed, I would argue that what's happening in those markets is way more scary. Now that you know what's really going on in those respectable commodities markets, you can school anyone who spouts that nonsense that you should stay away from crypto markets because of market manipulation. That's all for this video, but I need to tell you how to get this cracking Crypto King t-shirt. I'm selling these bad boys in my official merch store, which you can get to by clicking the link in the description below. Now, I don't run YouTube ads on this channel as I frankly find them annoying. But you should know that any t-shirt sales will help me keep doing what I'm doing on YouTube and keep the whole experience ad-free. So, thanks in advance. Finally, you've made it to the end. So, I guess you found this video somewhat interesting. So, send this crypto guru some good karma by smashing that like button and subscribe, or I'll join JP Morgan. I bet you thought that was all. Well, I always leave the best for last. And because you guys made it to the end of that video, I have something to share. This is my weekly email newsletter. It's my way of succinctly crystallizing my views on the crypto market for the week ahead. Nowadays, I also share unique insights as well as juicy coin tips. So, keen to be a part? Well, you better check out the description where I've linked to a sign-up form. All you need to do is enter your email address and hit submit. Be sure to confirm your address, and that's it. You're now locked, loaded, and ready to receive my next email. Oh, and it's weekly. I hate spam, and you won't be getting any from me.